Welcome back, Alpha Hunters. All right, so today we're going to look at Coke. We just went through and did some analysis on Coke, and we came up with an annualized plan to make some money here for a little bit over a double for about 118% return. So definitely stay tuned. Check this out. It's a little bit of a long video. There's some theory. There's definitely some neat little tips and tricks to kind of understand what a future option value could be worth. So stay tuned to all that and enjoy the video. Okay, so this is the beginning to get to that end result of how we want our trade to set up. Okay, so we are going to look at Coca-Cola here. And starting out, the real thought process behind this trade is it does seem like we're coming into the end of a longer term bullish cycle on the market in general. And this just kind of comes with some experience. Consumer staples usually perform very well during this period, as you see a lot of people rotate out of what has worked for so long during the bullish cycle and into more protective type of companies and investments like consumer staples. Okay, and for those that don't know what consumer staples are, they are like your food, your household products, things that you need basically to use pretty much every day. Okay, there are also going to be some stores like Walmart, Costco, Kroger, right? Grocery store Kroger that you go to all the time to buy your groceries. There are also going to be brands like Procter and Gamble, Kimberly-Clark, Colgate Palmolive, CL, and then some other food and beverage companies like Tyson, TSN, Hormel Foods, HRL, and then Coca-Cola and Pepsi. Those are the kind of companies that we were talking about here. So we're going to look at Coca-Cola, and from here we are just going to get a brief understanding of what its long-term chart looks like. Okay, so we can see the long-term perspective here. Bottom left, top right, so the chart pattern looks pretty healthy as far as its long-term trend. Looks really good. We did break out above the pre-COVID top here recently, so that's over the past couple months. So very good. It's kind of looks like there's nothing really up above it to make some resistance for the longer term. So let's go ahead and look at the daily chart. And this is really one of the big reasons why I wanted to look at a company like Coca-Cola today. If we look at the SPY, and what we can see on the SPY is we had about 3-4 months of recent choppy pullback action from the beginning of the year, or even maybe late November or November to mid-March, right? We've just had a lot of choppy action, a lot of some selling came in at the beginning of the year. But if we look at Coke, and we're not back at all-time highs yet, right? We're not back at all-time highs. So if we look at Coke, it didn't really get caught up in a lot of that. It got caught up in about a week or two of that at the beginning of March, but really outside of that, it's been performing very well. Even in December, it performed very well, and even into January, it did perform pretty well. February looked like it was pretty choppy, and then we did have that 1-2 week pullback in March. But since then, it has ripped it higher and is pretty close to its all-time highs. So with that being said, I do think that Coke and other consumer staples probably continue to be great investments going forward as we do kind of go into this end of bullish market cycle, and people will start to slowly kind of sell off positions that have worked in technology and look to go a little bit more defensive in consumer staples and other areas. So let's figure out what we can do to generate some returns going forward in Coca-Cola. So Coke is not going to be one that is going to be a high flyer and you can expect it to go up 10% in a week. Those will be massive outliers if Coke does that, because that's just not what they do. They're very predictable. They do pay a pretty good dividend, and you can check out their dividend on TradingView. Just click the D button down below, and they pay a 44-cent quarterly dividend. If we look at their quarterly dividend of 44 cents and times that by 4, we can expect an annual dividend of about 176. So that's not too bad. And if you want to know the rate of that, you just take the annual dividend and then divide it by the current market price of 61.82. We'll use that of 61.82, and your current rate is about 3%. So that's not that bad, not that great. Not a big dividend guy myself, but that is how you kind of find the rate of dividends to the stock price. And you can probably expect them to raise it every now and then. I don't know how often they do raise their dividends, but these kinds of companies do raise their dividends. But we're not here to invest in companies for dividends. So let's look at some option chain stuff. I want you to leave a stock in the comments below, and I'll come up with a trading plan. So we have Coca-Cola option chain here. What we can see is they do have weeklies going out for about 6 weeks. Okay, the reason why there's no weekly here is because this is a monthly option that already ends on a weekly, so that is a monthly option, but it's taking the spot of the weekly. Okay, so we do have weekly options that go out for 6 weeks. Now the next thing I would like to do is figure out what kind of time frame we would like to use. That way we know what expiration date. Okay, so how long do we want to be in this? So if we do think the market's going to be a little bullish going into the end of the year for the second half of the year, and consumer staples maybe not leading the market, but being pretty strong and that bullish for the remainder of the year, then we can definitely say, okay, let's go ahead and look to potentially buy some options probably for the end of the year or beginning of next year. You know, that's one way to do that. Or another way you could potentially do that, and one that I do like doing, as long as the stock has a very steady and clear uptrend, one thing that you could do is buy vertical options and maybe out every 6 weeks and just kind of rotate that. But as we look at their option chain here, if these option strike prices were every 50 cents, so if you had 60 and 60, 50, 60.50, and then 61, then 61.50, I would potentially be interested in doing that. But they don't have that. I'm not really interested in doing that on Coke because I know it is not that much of a high flyer. But owning options for the end of the year is something I could probably get behind. Now, what we can do is we can look for the Jan 23 potentially. Maybe the June 23. I think either one of these would be a pretty good area to start as figuring out which option you probably want to get into. So we'll look at the 65 here. And what we can see by the 65 strike for the Jan 23 is it is trading right around that 260, 265 area. And then the June 23 for the 65 strike is trading right around that 365 to 385 area. So for an additional 6 months, we'd be paying, it looks like roughly an additional $1, maybe a little bit over $1. Buying more time and giving yourself more time to see and watch and make sure Coke works out in your favor is never really a bad thing when it kind of comes to options, because you're not getting hit by theta as much. Theta's not much of a problem. So it kind of leads me to go with the Junes. Not to tie up as much capital, but you know what? We'll go with the June 23s here. Okay, so let's go ahead and we will look to buy these June 2023 options. I'm gonna widen this out a little bit. There we go. So let's get an idea real quick on the chart of what we're looking for. So if we're buying the 65 strike at roughly, we'll say $4, we want the stock for Coca-Cola to get up to 69. Is that something that is feasible for Coke to get to 69? Well, let's take a look. So we'll chart like a little bit of a trend line here, and we will see what it looks like going into the future. Okay, so we'll turn that off. So if we go to like June So it looks pretty good if it keeps on its current trend, and it is breaking above the pre-COVID high. So the area we would need it to get to would be pretty much right where my cursor at is at. That's about where we needed to be above that. That would be the break-even spot. So as we can see, as long as it stays on its current trend, it looks pretty good. Now, is it a little elevated in that current trend? Yeah, it might be a little bit elevated. You can maybe wait for a pullback. So this is maybe not one you have to get into today or maybe even over the next day or two. But I think it's okay if you did decide to go ahead and pull the trigger. Or maybe you said, you know what, I'm going to layer into this. I'll get a little bit of a position now. And then if it does wind up pulling back or if it does wind up going sideways, I'll add to it later. Okay, you can definitely split up your order entry that way. But I think just looking at that, I do think using the June 2023 options now, I think is definitely a little bit more of the safe way to go. The other thing that's kind of interesting to do here on Coca-Cola would be the wheel. Okay, the reason why the wheel is awesome on companies like this is you can rest assured that Coca-Cola is not going to go out of business, right? And Coca-Cola, maybe they go out of business down the line if they don't come up with like some cool space drink or something. But Coca-Cola is one that has a massive brand. They have so many different drink and food products out there in the marketplace. It's very difficult for them to get overthrown. If they feel the heat from a new brand, they just go acquire them, which another rant for another day. I'm not going to get into that. But doing something like the wheel would be pretty fantastic here. And what I like to do on the wheel is sell options as short term as I can. And we can see the stock is currently around 62. So really what I would like to do is I would come in here and I would sell a cash secured put, right? I would sell this cash secured put for like that week of 62 for 46 cents. As you know, the 62 strike, right? The strike that we're currently at for 46 cents. Here's why I like doing this on companies on Coke. Why I don't mind, selling it. You know what? I might even do this wheel strategy in my account because I'm not worried about Coca-Cola going to $40. I'm not worried about it going to $10 or $0. Coca-Cola is one of those things that as it becomes discounted, people step in and buy it up. And that happens pretty frequently. I might have a couple months of pain and just writing covered calls if I ever do get put the shares, right? Because we're selling a put here. So if I do get put the shares, that's fine. You just turn right around and sell covered calls. Now the covered calls you sell are going to be at the same strike price, but you might have to go further out in time. Okay? And what you're looking for is to eventually get your shares called away. So this is not a bad way to go either. And I probably will be looking to do this later in the day. Today, actually. As we see Coke's down roughly 1.25%, almost down at that 62 price area. So I would probably be looking to do something like that. And one of the big reasons why I do like selling at the money short-term options is because that's where you make the most money on selling options. That is where you make the most premium. As long as you are very confident in the company that you're doing it in, on the stock that you're doing it in, this is a great strategy to do. This is where you can get the most premium, okay? Is at the money, short-term options. That's where the highest theta is. And that's where I like to make my money on theta. But let's look back at the long-term options, okay? So the Jan 2023, I would say no. And here's another reason why, okay? So I don't too often talk about taxes, but the June 2023 is, if we look at where we are today, we're in April. So if we look at June, it is more than 1 year away. Here's the other cool part about these June over January 2023 options is that if you hold it for a year, your gain on these options goes to long-term capital gains. It doesn't go to your short-term capital gains. So you have a lot lower of a tax rate hit on this type of investment over the Jan 23s, because you're going to have to get out before 1 year on the Jan 23s, right? Now, I wouldn't normally bring that up, but it is something that might tip the scales for you if you're looking at some longer term options. Well, which one's over a year? Which one's under a year? I would typically lean to the one that's over a year. That way, if you do hold it for at least 365, then you could put those gains into long-term capital gains, which is a lot better than short-term capital gains, as many of us do know. So let's go ahead and look at doing these long-term, and I might do both positions. Actually, I might do the wheel strategy and these long-term Coke options, because I do like the idea of having some momentum stock appreciation skin of the game as we go into the end of the year. So we have $3.95 per share. So, and times that by 100 shares per contract, that'd be about $400 per contract. Another way to very easily check that is take this quantity down to 1, open this up, and you'll see your cost of trade is $400, roughly $395.66. Okay, so that looks pretty good. I do like the trajectory it's on, and if it winds up appreciating, let's talk about this. So I think I will do this, and if it gets probably anywhere to, I think 70, if it gets to the 70 point area, I think I would be looking to take that off. And if it got to the 70 point area by mid-November, so that would be, what is that, roughly 6 months or 7 months. So that'd be 7 months. So if it took 7 months to get there and went up 8 points, let's try to do some analysis real quick on what that would look like. Okay, so if we could get into that for $4, and then it takes 11 months, about the only option that's pretty close, not 11 months, but 7 months. So what we want to do is we want to go 7 months less than this June 23, right? Because we're doing this June 23, and if it takes us 7 months to get there, I think roughly this November would be the best point to look at, point of reference. So if we have Coke, which is currently trading around 62, and we're expecting maybe the stock just to appreciate 8 points from there to 70, then we go look at what option we were looking to buy, which I think we were looking to buy the 65 strike here, right? So we will take 8 points less than that. So 8 points less than the 65 strike would be the 57 strike. Now, the closest 57 strike in November would be 57.50, right? So that's the closest we can look, and we can see that it's about $6 and some change, six and a half. So that's not that bad of an asset appreciation on these options. And the whole thought process behind trying to do this bit of analysis is to see and use the option chain and the different times it has along the way to understand what we can expect our option to be in the future, right? So we're looking to get into this Jan 23, and we're going to look to maybe be in it for 7 months, because that's our current trend, is looking to get to 70 points by 7 months, and it's currently at 62. So if it goes up 8 points, and we'll be in it, and we'll be at the 65 strike, and it takes 7 months, so then you take 7 months off of June, that would be November, that would be the November strike, and then we were using the 65 strike, so then we take off 8 points, and that would roughly mimic the value of our 65 strike for June 2023. At that point in time, would be roughly valued at around 6.5 points. That is the idea behind this analysis. As the stock moves up in value, the 8 points, we'll say, the stock moves up 8 points. This becomes 8 points further into the money. Maybe not 8 points into the money, but we'll say further in the money because it's currently out of the money. And then we can see roughly which option closely matches that, which is this 57.50 strike. That is roughly the value that we will be looking for in the future. So that is not bad. That is, let's say we were looking to get out for, let's say, probably a little bit higher. I'll go a quarter higher. Okay, so 675 divided by 4. So that would be roughly a 69% return on this trade in 7 months. That's a pretty good investment, 67% return. Now, if we do want to annualize this number, what we do is times it by 12 and then divide that by 7. And that gets us to roughly a 118% return annualized. And I do like to usually annualize my returns because it standardizes my expectations of a return for any trade. Some trades are a month long, some trades are 2 months long, some trades are a year long, some trades are more than a year long. This just helps me understand, what kind of trades am I getting into, and what kind of reward opportunities I'm having over those time periods. Okay, so that is really not a bad way to go and trying to do something that's a little bit more low key. So we looked at a couple different scenarios. I think doing the wheel strategy is not a bad way to go. If you do go maybe some longer term options, doing the Jan 23 is not a bad way to go either. And you're looking to get a roughly, for an annualized return, a 118% return. And you can let it go longer than 7 months, but the 7 month return, we were looking at a 69% return roughly. It's just kind of up to how you want to go about it, how you want to manage it from that point on. You can hold on to it for the 12 months, get to that 1 year mark and have a lower tax rate. That's not a bad way to go. If you kind of don't want to understand what you're looking at for the wheel strategy, remember we could get into that for 40 cents. So we'd be selling 40 cents, and then you divide that by the current stock price, which would be roughly 62, and that would be a rate of less than 1%, right? So that's gonna be less than 1%, but you're looking to do this weekly. So if you want to get an annualized return, remember, just go ahead and times that by 52, and you're looking at roughly a 34% return, annualized return, selling those weekly options. Okay, so obviously not another way, not bad to go. And that's cash flow. That's one thing that I do like doing the wheel. That is cash flow. So not a bad way to go there either. So hopefully you learned some pretty valuable things. And really it's kind of up to you on how you want to go with this. The wheel, not a bad way to go on a company like Coke. And then we also got a way to go with a longer term option. You can hold it for longer than a year and get into that long-term tax bracket with the June 23 options. I do like the 65 strike myself, as I do like going a little bit out of the money. Alrighty, take care, Alpha Hunters.